Sorry, Manoj, you're on mute, I guess.
I've just unmuted it. Indicators, we help partners scale up business digitally. And today we have Aniruddha Naha, who is a senior fund manager from PGIM India Asset Management Company, who is Aniruddha, did I miss out in between? Hello.
I couldn't hear you, Manoj. Actually, it was on mute, and then at some point it hung up, I think so.
Yeah, I'll restart. I just got disconnected.
Okay. Yeah, that would be better. Actually.
Yeah. Sure. Good evening, partners. Warm welcome from AssetPlus. AssetPlus is a digital partner platform for financial advisors. We are AMP licensed aggregators. We help partners to scale up business digitally. Today we have Aniruddha Naha, who is a senior fund manager from PGIM India Asset Management Company, who is handling PGIM India Diversified Equity Fund and Mid-Cap Opportunities Fund. Mr. Aniruddha is having 18 years of experience in equity and debt markets. He was with Avengers Wealth Management heading PMS. Prior to that, he was with IDFC AMC, Mira Asset, and DSP BlackRock AMC. So here we have the most experienced speaker today. He is going to talk on zebra in the line country. Over to you, Mr. Aniruddha.
Sure. Thank you, Manoj. Good evening, ladies and gentlemen. Thank you for giving us an opportunity. Wish you all a very happy new year, and hopefully this year turns out to be far safer and better than what it was last year. So the title might be a little intriguing, because what is a zebra in lion country doing in the investing world? So we'll start off with the story, and then we will boil down to probably sectors and what we do, etc. This is a book actually written by one of the best mid-cap investing books that I have come across. The name is Zebra in a Lion Country. It is written by a gentleman called Ralph Wagner. And what the book says is fund managers behave like zebras. They like to herd together. I'm sorry. Sorry about that. So what they say is portfolios. So just like zebras come together, they herd together. Portfolios are also pretty similar. They herd together actually in that sense. So if you are a zebra, if you are basically, and you are in a herd, it gives you a lot of safety from the lion in a forest. So probably if you are a zebra in the crowd and in between at the center, you are probably very safe, because it is very unlikely that the lion will attack you. There are other layers of zebras in front of you. They will probably get attacked. But the problem with such a thing is, when you are in a crowd, you will never get green grass. The grass is all trodden over by the other zebras. So for fresh grass or fresh fodder, you will have to stand at the periphery or at the outer boundary, or you have to stand out of the crowd where probably fresh grass is available. The problem in such a stance is you might get attacked by the lion. So where you stand in the overall scheme of things, will determine your risk reward. The risk that you take is you stand on the outer side of the periphery. The reward is you get better grass. If you don't take risk, if you stand at the center, well and good, you will be completely insulated, but you will not get fresh grass. Same is the case with building portfolios. When you look at invest portfolios across different segments, most fund managers or most of the industry is like a herd of zebras. They look very similar in terms of the portfolios. Last three and a half years, we've been running portfolios where we've been a zebra which has stood outside the herd. We've either been at the periphery or outside the crowd. Why do we say that? We have data which shows clearly that the overlap of our portfolios with the benchmark is less than 30% consistently for both the funds that we talk about. That means 70% of the portfolio is different. And that is where our differentiation comes from. Now, what it does is it creates a chance of, if that 70% which is differentiated, if we do a good work and go ahead and build a portfolio where we are confident about it, that 70% is where you can go ahead and create alpha in the portfolio. But there is a risk. Yes, of course, like any investing process, if you go wrong, you will be the only person going wrong. So probably it would be something like a lion attacking. Our senses, our processes have been very strong, and hence to that extent, we've been able to stand out of the crowd and enjoy green grass, which is reflected in probably the returns that anyone can have a look at. So that is the story behind the heading, a zebra in a lion country. Large parts of our portfolios, I even manage the small cap fund. The overlap vis-a-vis the benchmark is less than 15%. So what we are trying to say is we are trying to give your investors a very different portfolios, and that is where we will go ahead and create alpha. So if you are allocating money, let's say for your investors, let's say in the mid cap segment, and you pick up 3 funds or 4 funds from where you will choose, the likelihood is that if you choose our fund will look a little different from the rest of the 3 odd funds that you have, and hence within a segment also it will give you diversification. And that is the aim of creating portfolios which are a little different, very low on overlap, and create diversification within a segment. Now, coming to a little bit on the process part of it, and after that we can move to individual sectors and how we are looking at the market, and then we can open it up for questions. See, from a process part of it, if you look at what we have done, we have focused completely on building clean portfolios with very low risk. Our process aims at the fact that we should have very low risk or downward draft. If you look back into say 2020, March 2020, or even the last month when the markets corrected, our portfolios fell less, because our idea is to create portfolios where in a downside we should be able to protect capital. And protection of capital itself should be a big factor generating returns over a period of time. So we focus firstly on operating cash flows, which is basically the cash flows generated from the operations of a business. And what we say is, in 70% of time in the history of a business, it must have positive OCF. So basically it means that businesses go through business cycles. Every 5 years there is a down cycle and an up cycle. We want to see which are the companies which in its down cycle are able to manage cash flows better. Because see, companies can play around with profit and loss statements, they can play around with the balance sheet, but it's very difficult to play around with the cash flows, and that's why our focus is on the cash flows. So in 70% of the time, the company must have positive OCF. That is the first one. Secondly, we like businesses where balance sheets are clean. So net debt to equity less than 2. That's the second thing. And third is, there should be no major corporate governance issues in the company. These 3 things, if you think of it, all 3 are aimed at protecting the downside or reducing mistakes in the portfolio. And that is our sense of, even though we stand outside the crowd, where the risk is high, even though the portfolios are very different, and hence the chances that we might be wrong, is there. But the fact that our process is so strongly focused on ensuring safety of the downside, we've been able to successfully be a zebra which has stood out of the crowd and deliver alpha. So that's the definition and understanding of the term zebra in a lion country. Now, coming to the sectoral part of it and how we are looking at the markets. See, from a sector's perspective, two things you will have to understand which has played out very well. So the first part is we've been overweight IT for a very long period of time, and we believe IT is a sector where which will continue to deliver 15 to 18% kind of growth with reasonable cash flows, clean balance sheets, etc. The world, because of COVID, is seeing dramatic transformations in the digital world, and adoption of technology has been very fast in the Western world. Now, when a company adopts technology, it needs to get implemented, and that implementation work is done by the Indian IT companies. And that's why we believe the next 18 to 24 months, which is almost 2 years, you're going to see good amount of technology adoption and implementation going across the world, which should help Indian IT companies. So that is one of the sectors which have been the cornerstone of our performance. And we continue to believe that this is a sector which will deliver even through bad times. Just in case the markets are weaker, sentiments are negative, this is a sector which will give you downside protection also, along with growth, as we spoke. The second place where we are positive on is the fact that we like industrials very much. And by industrials, we mean capital goods and industry oriented businesses. Now, the reason why we like this is if you look at corporate India, they have not invested into capacity expansions in the last 7 to 8 years. So there has been no major capex that has happened in the country. Today, corporate balance sheets are very clean. The balance sheets don't have debt because last 4 5 years they have every profit and cash flow has been used to repay debt. And this is just not the large caps; it is for the mid caps and small caps. So today, corporate India has the capacity to do capex because the balance sheet is clean, and the utilization levels are very high today. In many of the industry, utilization levels are 80%, capacity utilization levels. Most of the country is above 70%. What does this show? This shows that there is enough demand, but there is not enough capacity. So capacity expansions will start happening, and the investment cycle should do well in the next 3 years. If that is the case, where the investment cycle does well in the next 3 years, we believe industrials as a segment should do really well. And hence, our belief is this is a segment, or this is a sector which should do very well over the next 3 5 years. Even in capex, frankly speaking, corporate capex, there are two parts. One is the opex capex, and the second is the capex. By opex capex, we mean companies which generally when the demand starts picking, first companies try to elongate the life of the existing plants, and then they will set up new plants. To elongate the life of an existing plant, they will use bearings, they will use nuts and bolts, they will use welding, abrasives, etc., just to try and elongate. This is the opex capex part of it, where people will try and instead of, probably if the life is 3 years, they'll try and make it 3.5 years, trying to extend before actually going ahead and setting up another capacity which has a life of, let's say, another 3 5 years. So the opex capex part of it is already showing, because we are seeing huge demand for bearings, abrasives, welding equipment, all these kind of operational capex items. So industrials is something that we like, and we believe this is a segment which has not participated in the markets over the last 7 8 years. But clearly, from the fact that corporate India is setting up capacities, this is a segment which should do well. If you think of it, the government has been trying to push PLI schemes across a lot of segments. This itself is an indication that the government wants capacities to be set up in the country. And manufacturing facilities, if they're set up in the country, will result in corporates setting up new manufacturing facilities, new capacities, and hence industrial should do well over the next 3 5 years. The third segment where we are positive on is real estate. Now, this is a sector which had literally died out in the last 5-6 years. This is a long cycle, this thing, industry. When it dies out, it dies out for 3-4 years. When it comes back, it does well for the next 3-4 years. We believe the industry, real estate segment has just started doing well in the last 6-9 months, and the next 3-4 years they should do well. Real estate has a lot of cascading impact on other industries. Positive, when the real estate is doing well, it has a lot of positive impact on other industries. Two-thirds of cement demand comes from real estate. So if real estate does well, cement does very well. Then real estate doing well, you have demand for tiles, faucets, steel, wires, uh, you name it. Then plywood, paints, all a lot of ancillary industries which are associated with real estate starts doing well. And if real estate does well, you have the home lenders, people who lend for home building, the housing finance companies, etc. They start doing really well. So it's a big ecosystem which does well. We believe, given the fact that IT is doing well and other segments are also started doing well, real estate should do really well. And over the next 3-5 years, along with real estate, you'll have a lot of these ancillary businesses doing well. So this is another segment where we continue to like, and we believe this is very well, ready for growth to that extent. The other segment where we believe it will give you stability in the portfolio. Growth might not be huge, but it will lend a lot of stability on the downside, and that is pharma. See, pharma is, again, it is divided into domestic pharma, which is pharma for the for the country, and the overseas pharma. Uh, Domestic pharma is doing pretty well. And that is something which we believe should do really well going ahead also. Uh, Clearly, because people have become far more conscious of their health after COVID, and that is reflecting in the demand for medicines across a different segments. So that is one segment where we believe growth will be there, the domestic part, along with decent margins. Plus, this is a very defensive sector. Whether the economy is doing well or whether the economy is doing badly, this is a sector which continues to do well, and hence it's very defensive. So this segment we believe will do well. Also, on the overseas part of the business, I think a lot of Indian pharma companies, they are building their capabilities on the specialty side of pharma, and specialty is a higher paying, higher margin business, and we believe there are a lot of companies which should do well as specialty pharma starts doing well globally. So pharma is something that we believe should be a part of the portfolio. It should do well, and that should drive demand, and it will also provide protection in the overall portfolio. There is one sector which is a smaller sector which we believe over the next 3-5 years should do very well, and that is textiles. So textiles was a sector which was completely forgotten over the last 7, 8, 10 years. Stocks did nothing great, but what has happened, you'll have to realize, is textiles is an industry which provides a lot of employment, and the government realizes this, because in India, job creation is very important. So they have started incentivizing the textile sector through PLIs. They are asking companies to set up capacities. The government will give them the benefits under the PLI schemes. Also, add to that, one has to realize that today China is under a lot of pressure, especially on the textile side. So the US and Western world have banned cotton which is produced in China. Now, other than China, one big country which provides the full value chain in textiles, starting from cotton to end garments, is India. India is the only country other than China and probably one more which has the capability of growing cotton, and all the parts of the value chain up to garmenting, creating garments and selling it out. So it provides a huge opportunity out there. The Indian government is talking about a PLI scheme. So we believe this sector, which was something which was literally forgotten, has the capability to become a large sector, like what has happened with chemicals. If you think of chemicals 5 years back, it was a very small sector. And today chemicals also is another sector which should do really well in the next 4-5 years. just because of the China plus one policy. Uh, Even in textiles, it's literally becoming a China plus one policy. Everyone in the Western world is looking for an alternative as supply chain or market to from where they can get supplies, and India will stand out there on textiles. Coming to chemicals, I think so. There is still a lot of value to be created. The only problem with chemicals is the stocks have run up very sharply, and hence the valuations are expensive. We believe there is a chance that some amount of valuation compression can happen in this sector, but the earnings growth will continue to remain robust. So at lower valuations, I think so we will turn again very positive on this sector. But presently, as we speak, we are more or less neutral on this sector purely because of valuations. Now coming to sectors where we have been underweight on and what we haven't liked. The first is consumers, because we believe till now what was happening last 5 7 years, the across governments they were doling out money to the poor people, and that was driving consumption. But that's a very direct way of helping poor people, no doubt, but it doesn't create any asset. Now the government is probably doing what is needed. They are creating jobs or creating PLI schemes which will uh, allow a lot of companies to set up manufacturing facilities in the country. So assets will get created. Once an asset gets created, it helps in job creation. So jobs will get created permanently. So over a period of the lifespan of that industry and the facility being set up, you will have some or the other people getting employed in there. So it will create employment, and once it creates employment, it will create household incomes which will drive consumption. It is a little longer process of that consumption coming back, but that is the right way. Our belief is because of the COVID wave that has been continuing, the lower middle class, the rural India, and the urban poor have been hit. Because of that, there have been job losses, absolutely no doubt on that. So this will impact consumption to a certain extent. There will be impact. Also, what is happening, which is something very good to happen. Till now, people were never bothered about their life insurance, health insurance, etc. Today, across families, everyone is trying to create a buffer for medical purpose through life insurance or something. So when you do that, if your salaries are limited, you will actually cut down on consumption to create that buffer. And that is what is happening. And hence, we remain a little cautious on consumption. Consumption, the valuations are also very expensive. So if someone has a 5 10 year view, consumption will do well. But our belief is in the next 2 3 years, consumption could underperform. It has already underperformed in the last 1 1.5 years. We believe there could be some more of underperformance for consumption before it starts taking off. And mind you, valuations are expensive. The last sector where we have been negative on for almost 2 2.5 years, this was a sector where, when we say we've been a zebra standing out of the crowd, we were underweight financials big time. In the last 2 2.5 years, most of the industry was overweight financials. Now I will come to why we've been underweight financials and what is our thought process. We basically think this is an industry, there is too much of competition. Any industry where there is too much of competition, margins reduce, profitability comes down, and it hits your ROE and ROCs. So they come down. Today, if you think of it, there are new banks, new NBFCs, new MFIs, new SME banks, MSME banks, gold loan financing companies. Then there are the Bharti Airtels, WhatsApp, Google Pays, etc., all participating out there. Now you have the fintechs, new fintechs, all backed by private equity guys who have entered this field. So they say borrow now, pay later. So the competitive landscape has gone up dramatically, number of players, and that has increased competition. So that is one reason why we have stayed away from. The second reason why we stayed away from financials is the fact that the asset quality was an issue. In a slowdown, it will reflect on asset quality, and we are still probably just coming out of a slowdown to that extent. So probably the next 1 or 2 quarters, or probably the next 3 quarters, you will see certain amount of asset quality issues also playing out. So that is one reason why we've been away from financials, and we believe there is no reason or no hurry to be a part of, go overweight on financials. This is a sector we are tracking very closely. Interest rates are supposed to go up in the country, and not just country, globally also. If interest rates go up, it becomes a big pain for NBFCs also, because they do not have current accounts and saving accounts like banks. So again, from that perspective, we've been a little cautious on financials. The only place where financials we think a long-term growth is sustainable is insurance, and that is something that we are looking at very closely. So that is basically the overall sectoral presence that we are there. Lastly, I'll just come to a few minutes on what we are doing in our portfolios, the flexi cap and the mid cap, and why you should probably look at them, and then we can open it up for questions. Now, looking at the two funds the main funds that I manage, other than the small cap, was also another fund which I manage. But coming to the diversified or the flexi cap and the mid cap. Now, the flexi cap first, our flexi cap has really been a true to the sense flexi cap in that sense. Consistently, we've had 45 to 55% large caps. The rest of it has always been mid and small caps. So from that perspective, we have been uh, running it like a flexi cap rather than just hiding in the large caps out there. Now today, as we speak, we are about 55% large caps and 45% mid and small caps. We run the portfolio with about 45 to 50 stocks, and the top end of the portfolio, which is about the top 10 stocks, will be about 35%, and the remaining will be the others. We are overweight, as we said, IT. We are overweight pharma. We are overweight industrials. We have textiles out there. We have real estate out there. We have financials. It's not that we don't have financials, but we are underweight there. And consumption, we have a few names in the consumption basket. Coming to the mid cap we have consistently run with about 20 to 25% small caps, and the rest of it has been largely mid caps, and it's about 3-4% large caps. Now, this is again another fund where the overlap has been very less. We have stuck to about 45 to 50 names here also, very similar construct to that extent. And the small cap portion, we continue to believe over the next 3-5 years, at least the next 3 years, you will see a lot of re-rating happening and wealth creation happening in the small cap segment. And that's why we have given a decent exposure to small caps, both in our flexi cap and the mid cap. That was one of the reasons why last June, July, we again launched our small cap fund also, which today is doing reasonably well, and only time will tell how it plays out. The reasons, finally, I'll just summarize this as to the reasons why probably you should take a look at our funds, whether it is the flexi cap or the mid cap. See, one is the overlap. As I said, our portfolio construct is very different, and hence you will get a differentiated portfolio for your investors. So if you are looking at one or couple of funds or three funds out there, our fund will look very different from the remaining two. So within that segment also, it gives you a decent amount of differentiation or diversification. Our portfolios have consistently had high ROEs vis-a-vis the benchmark. And this is just not now. Over the last 3 years, 3.5 years, we have consistently run the portfolio with very high ROE companies. The debt in the portfolio is very less. See, the risk in markets or the volatility in markets happen because if you are running with companies or running a portfolio with companies which have too much of debt. Most of our companies don't have too much of debt. So from a debt equity perspective also, it is a very clean portfolio that we run. And hence, vis-a-vis the benchmark, our debt to equity is also far lower. The beta of the portfolio is also very low. A lower beta vis-a-vis the benchmark. A lower beta means the volatility in the portfolio is also low. And that we have demonstrated in any fall. If you look back, you will see we have fallen less. And of course, the overlap part is something that we continue to highlight. So just to summarize it, when you look at our funds, our returns have been good, but the returns have been good not just because we were participating on the upside. We have participated pretty well on the upside, but we were able to protect the portfolios on the downside also. And that is our motto, where we will try and protect the downside initially as far as possible to protect capital. Because if our sense is if we can protect capital, we should be able to grow the portfolio returns far well. And one thing that we focus on is cash flows, as I said, because this what we believe in is top line is vanity, bottom line is sanity, and cash flow is reality. So if businesses just grow top line, that doesn't count. It doesn't matter. If businesses just grow profits, that also can be manipulated. That is important, but it can be manipulated. But cash flow is reality. You cannot play around with the cash flows. So that is something that we believe is some of utmost importance to us. So I will end it there. And Manoj, we can open it up for questions. We have about, I think so, about 25 minutes. Very happy to take questions from your advisors.
Yeah, thank you, Aniruddha. Partners, if you have any questions, you can chat in the live chat, or you can unmute yourself.
I would request, please use this opportunity to ask any questions. We'll be very happy to, share our thoughts on it.
Aniruddha, Mr. Srinivas Raghavan is asking, what has been your alpha in your fund management?
So thank you for that question. I don't have it up in front of me, I think so, but I can tell you for sure. The alpha generation in both our funds have been top class or top tier in that sense. Our funds have actually been ranked among the top, among the best performing funds in both the segments. But in terms of specific numbers, Manoj, I think Rakesh is there. He can get back to you with, what has been the alpha that has been generated. Our this thing is style has always been not to create beta in the portfolio. The returns have not come because of high beta, but it has come because we've been running the portfolio with low beta, and that has led to generation in alpha. Specific numbers we can get back to you on that, Manoj.
Great. We can see Ajay Gopalan asking, what is your feedback on small cap performance of your fund?
So see, it's been about 6 months. In the drawdowns, we have fallen less. I think the performance has been pretty decent. We are somewhere around the first quartile or second, top end of second quartile. I haven't tracked it very closely, but my only sense is just as investors have given us 3 years, 4 years while evaluating our mid cap and our flexi cap, we would suggest give us at least a year, year and a half before starting to evaluate our small cap fund. But I can tell you the thought process is same. We will not take unnecessary risks, and we will try and protect the downside, and that should help in creation of alpha over a period of time.
And Mr. Shail Malik is asking, do you have any international exposure in FlexiCap?
No, we have an enablement where we can do that. But believe me, our thought process is India has a lot of opportunities over the next 5-10 years, I think so, or this decade. India will give you the bigger opportunities to play out. So we will, though it is enabled, we will both for the mid and flexi cap. We don't think we need to, take an exposure on the overseas markets just to create alpha. I think so. We should be able to do it just by investing into the country, into Indian companies.
Great. Okay. And a few of the partners have asked a similar question. What they're asking is, in 2020, we can foresee some couple of Fed rate hikes, as well as, is there any chance of RBI also going to do the same in our market scenario?
This is 2022, right? You're talking
yes.
about.
Yes.
So now this is coming to our view. We have been saying very vociferously that interest rates will move up. There is absolutely no doubt. The Fed was actually behind the curve, and so we believe even the RBI is behind the curve in that sense. The Fed was of the opinion that inflation is only transitory, and now that transitory word is out. They said 2023 will be the first time when interest rates will be hiked. Now they're saying 2022 at least 3 rate hikes, if not 4. I believe even in India, the US 10-year, the Indian 10-year has already moved up by 60 bips. We are internally building in 100 bips rate hike in the country, and accordingly building our portfolio. So whenever interest rates move up, it creates some amount of near-term volatility. There is no doubt on that. We will use that opportunity to build our portfolios. We think that will be a great time to build portfolios, but we are very cognizant that when we are building a scenario, when building the portfolio, we are clearly thinking that interest rates are, let's say if the interest rates are up by 100 bips, then where will we invest? And that is how we are building the portfolios. To answer your question in short, yes, absolutely, there is no doubt. It would be safe to assume that India will see 100 bips rate hike in this calendar year.
All right, which means that the portfolio is ready for upcoming any rate hikes in the future.
Yes, absolutely. And that is why we are underweight financials, to that extent, and we have a decent exposure to IT and pharma.
All right, great. And a couple of questions together I'm asking, what is your view on auto technology for the next 2 years?
Sure. So I'll come to technology, where we have been very positive. We continue to believe technology will do well. The transformational changes that are happening, and the adoption of technology, whether it is cloud, digital, AI, machine learning, IoT, etc., these will all require implementation, and hence Indian IT companies will continue to deliver very strong results. I think we have already seen a few names which have delivered results till now, and the results have been pretty decent to that extent. So our sense is the next 4 to 6 quarters, one shouldn't be very worried about IT companies delivering. Now coming to auto and auto ancillary. See, auto and auto ancillary, there is one thing which is happening. There are a couple of challenges. The first challenge is something which will get resolved. It's a matter of time, which is the availability of semiconductor chips. Now, earlier on, it was thought by June availability should be there. Now people are saying it's going to be around December of this year. So there is a shortage in the near term. And when semiconductor chips availability comes up, you will start seeing demand, because there is demand for vehicles. You will start seeing supply, and the company should start doing well. But if you ask me from a next 3-year view, I think the next 3 years will look far better than what the last 3 years were in terms of auto sales numbers, profitability, etc. So the sector probably is sitting at the bottom, and it should slowly start doing well. The challenge, I think, a longer term challenge is how what happens to the sector with EVs coming through, which is electrical vehicles. See, electrical vehicles are a reality. There is no doubt. Whether whether companies are able to supply them in bulk, etc., in the near term, or whether it's going to take some more time, it's a matter of time that this will become a reality. But it will be a reality in two-wheelers and buses, because in two-wheelers it's very easy for adopting it. You can easily take out the battery, charge it at home, and then come and put it back into your vehicle and start. So because of the convenience, and the price points are also pretty reasonable, though more expensive than the normal two-wheelers, but people will adopt the electric vehicles. There is no doubt. In buses also, since it's a huge number of people using the buses, this battery swapping will happen, and it will get adopted. The issue is it will take a far longer time in adoption in trucks and cars and this thing, because you will require a certain amount of infrastructure, etc. For the two-wheelers, you don't need an infrastructure. You can actually take it home, charge it, and bring it back. So setting up of infrastructure, etc., will determine how the adoption in the four-wheelers, passenger vehicles, and commercial vehicles will happen. All said and done, in spite of all this, disruptions happening, one thing you can be rest assured: not more than 20% of the vehicles will get converted to EVs on roads by 2030. For whatever is said and whatever people say, so both of them will be there. But our sense is, because of the disruptions in the vehicle manufacturers, we would rather play the ancillary companies which supply to the vehicle manufacturers, because One is they supply not only in India, they supply globally also. Secondly, they supply to the normal two-wheeler, four-wheelers, and they supply to the electrical vehicles. So when we are selecting the electrical ancillary companies, we need to be very sure about what product they supply. They should not get obsolete, because of EV adoption. And if we can do that, I think so some of these companies have a great future.
Great. It was very well explained. And understanding the known scenarios, the budget coming in next month, and as you're saying, like there are rate hikes in the upcoming, 3-4 quarters. So will it be a volatile session in the market, or it will be a correction force in next 6 months to 12 months?
So if you ask me, I think one should be prepared for volatility in the next 6 months. I think so. This year also, the returns will be positive, but it will not be anywhere near what we have seen last year. So we are internally probably building in a 15% kind of return on the Nifty. Now, whether the 15% will be front loaded and then you have nothing at the back end, or whether it is going to be, a down 10-15% in the initial part of the year, and then you get a 30% kind of return in the second half of the year, I would vouch that it will probably be the second one, where we will see some amount of downside in the near future. But understand something, the downside could happen, but the earnings trajectory in the country will remain strong for the next 15 to 18 months at least. Why we will see a downside irrespective of the fact that you have strong earnings is that P's will compress because interest rates are going up, cost of capital is going up, and some of the segments where P's are very expensive, they will see a correction. But having said that, the next 6 months will be a great time to build portfolios. Anyone who is looking to build a long-term portfolio for the next 3 years, 5 years, 10 years for the country, I think the next 6 months should give you a good opportunity. What we have been advising investors is, if you are really long-term, don't worry. I mean, you could time it, but at the max, spread out whatever investments you have, you want to invest in the markets over the next 6 months.
Yeah, great, Aniruddha. We have come to last two questions.
Sure.
Will government allow MF industry to start crypto as a segment for mutual fund investments?
See, Manoj, I am a wrong person there. I have absolutely no understanding of crypto. Let me be very upfront about it. And hence, whether it will be, so I am supposedly a financially literate person. If I don't understand cryptos, whether cryptos will generally be allowed for the retail participation, I don't know, frankly speaking. We'll have to
Got it. Okay. And the last question, as you told, there could be a possibility of 100 bips hike in interest rate in India. So how would be impacting our debt funds, maybe liquid or maybe our low duration products?
See, I'm not a debt fund manager there, but my sense is, if you ask me, uh, I would be there on the shorter end of the curve. I would avoid playing duration because there could be some amount of duration risk playing out there. But I think so. The better person to speak on this is my fixed income CIO or the head of fixed income. He has a better view. These are my personal views where interest rates moving up could impact duration in the fixed income portfolios.
Yeah, great. Aniruddha, almost all the questions are over from the partners.
Sure.
Yeah, it was really insightful session, and you have very well covered on infra as a segment should do well, and it's how the ancillary industry would get benefited out of its recovery, and pharma as a theme should do well as the COVID persists in the market.
Yeah.
And you have very well explained on textile as an industry should revive as large as chemical industries, as market scenarios are favoring Indian textile industries.
Absolutely.
And as you said, underweight on consumer segment will continue, and financial services you were underweight for the last 2 years, which have favored your portfolio. And it was very good session and insightful for our partners. And thank you so much, sir.
Thank you for having us. It was a pleasure speaking to you.
Yeah, thank you so much, partners, for joining the session.
Thank you.